1935, Shanghai. The financial capital of Asia is dying. Every day, silver flows out of China like blood from a wound. The currency is collapsing. The government is paralyzed. And across the Pacific, American politicians have no idea they've just triggered the greatest monetary crisis in Chinese history. This is the story of how good intentions destroyed an empire. Welcome to The Wealth Timeline, where we uncover how money, power, and history intertwine to shape the world we live in. What happened in Shanghai between 1934 and 1936 wasn't just an economic crisis. It was a monetary earthquake that would reshape Asia's largest nation, empower communist revolutionaries, and prove that in global finance, what happens in one capital can destroy another half a world away. To understand how China's money vanished, we need to go back to a peculiar fact. While the rest of the world used gold-backed currencies, China in the 1930s operated on a silver standard. For over 2,000 years, silver had been China's monetary foundation. Spanish silver dollars flowed through Canton. Mexican pesos circulated in Shanghai. The Chinese yuan itself was defined not in terms of gold, but in grains of pure silver. By 1933, China held approximately 500 million ounces of silver, roughly 1/4 of the world's monetary silver supply. This wasn't nostalgia, it was strategic reality. China's vast peasant economy, encompassing 80% of its 500 million citizens, operate almost entirely in silver coins. Paper currency existed in cities, but rural China, where most people lived, trusted only the weight and purity of silver taels. But there was a problem lurking in this ancient system. China's silver standard made it uniquely vulnerable to global silver prices. When silver prices rose internationally, Chinese currency became more valuable, but only on paper. In reality, rising silver prices created a catastrophic incentive. It became profitable to melt down Chinese coins, export the metal, and sell it abroad for more than its face value in China. And in 1934, the United States was about to make silver prices soar. The question is, did anyone in Washington understand what they were about to unleash? The crisis began with American politics, not Chinese economics. In 1933, Franklin D. Roosevelt took office during the depths of the Great Depression. His New Deal coalition included powerful senators from western silver mining states, Nevada, Colorado, Montana, Idaho, who demanded government action to raise silver prices and jew their collapsing industry. Their champion was Senator Key Pittman of Nevada, chairman of the Senate Foreign Relations Committee. Pittman didn't just want higher silver prices. He wanted silver restored as a monetary metal alongside gold. He had the political leverage to get it. On June 19, 1934, Roosevelt signed the Silver Purchase Act. The legislation authorized the U.S. Treasury to purchase silver until it constituted 1/4 of the nation's monetary reserves, or until silver reached $1.29 per ounce, nearly double its current price. Treasury Secretary Henry Morgenthau Jr. began aggressive buying immediately. The effect was instantaneous and global. Silver prices surged from 0.45 per ounce in April 1934 to 0.81 by April 1935, an 80% increase in 12 months. For American silver miners, this was salvation. For China, it was a death sentence. As international silver prices climbed, the exchange rate paradox hit China with full force. The Chinese yuan, tied to silver, appreciated sharply against other currencies. Chinese exports became unaffordable. Japanese goods flooded Chinese markets. Factories closed. Unemployment soared. But worse was coming. With silver now worth more as a commodity than as currency, massive outflows began. Merchants, bankers, and speculators melted down Chinese coins and shipped the metal to New York and London. Between July 1934 and October 1935, China lost approximately 250 million ounces of silver, half its monetary base, in just 15 months. Chinese Finance Minister H. Kung sent desperate cables to Washington. He explained the crisis in stark terms. The Silver Purchase Act is destroying our economy. The Chinese government imposed export taxes on silver, then outright bans. Nothing worked. Smuggling networks thrived. Silver continued hemorrhaging from Shanghai to San Francisco. By mid-1935, China's banking system was in free fall. Rural banks collapsed first, wiping out peasant savings. Then urban banks began failing. Credit evaporated. Businesses couldn't get loans. The money supply contracted by 30%. In Washington, Treasury officials recognized the problem too late. In May 1935, Morgenthau privately admitted, "We are doing China a great injury." But he couldn't stop. Political pressure from Western senators was too intense. China was being destroyed by a policy that was never intended to target China at all. October 1935. Shanghai's financial district is in chaos. Bank runs sweep through the city. Crowds gather outside institutions that had stood for generations, demanding their deposits. Some banks pay out until their vaults are empty, then close forever. Others simply lock their doors and disappear. The nationalist government under Chiang Kai-shek faces an impossible choice. Continue the silver standard and watch the economy disintegrate, or abandon the monetary system that had anchored Chinese civilization for 2 millennia. On November 3rd, 1935, Finance Minister Kong makes the announcement: China is abandoning the silver standard. Effective immediately, all silver coins must be surrendered to the government in exchange for new paper currency, the fabi, or legal tender. Private ownership of silver is criminalized. The yuan is no longer defined by silver content, but managed by central bank decree. It is the most radical monetary transformation in Chinese history. The government confiscates approximately 260 million ounces of silver from its citizens. Much of this is immediately shipped to the United States and sold to the Treasury, the very institution whose buying had caused the crisis. To stabilize China is new paper currency. But the damage is profound and irreversible. China's peasant economy, built on centuries of trust in silver's tangible value, now faces a paper currency backed by a government weakened by crisis. Inflation begins almost immediately. Rural China, which never trusted paper money, begins hoarding goods instead. The economic psychology of an entire nation has fractured. Between 1935 and 1937, China's wholesale prices rise 40%. The wealth transfer from savers to the state is massive and invisible. And worse, the monetary chaos creates political instability that the Chinese Communist Party will exploit with devastating effectiveness. Because while the nationalists struggled with monetary policy in Shanghai, Mao Zedong's forces in the countryside were offering something simpler: land redistribution and the promise to end economic chaos. The silver crisis didn't just destroy China's currency, it destroyed faith in the government that managed it. The Shanghai Silver Crash of 1935 offers a blueprint for understanding modern financial contagion, and a warning about unintended consequences in global monetary policy. Consider the parallels. In 2013-2015, the U.S. Federal Reserve's taper tantrum, merely signaling an end to quantitative easing, triggered capital flight from emerging markets. Currency crises in Turkey, Brazil, and Indonesia, and a near collapse of the Chinese stock market. The mechanism was different, but the pattern identical. American monetary policy, designed for domestic purposes, created chaos abroad. Or look at 2022. The Federal Reserve's aggressive rate hikes to fight U.S. inflation sent the dollar soaring, crushing currencies from the British pound to the Japanese yen, and pushing Sri Lanka, Pakistan, and Egypt toward default. The lesson from 1935 remains urgent. In an interconnected financial system, there are no isolated monetary decisions. China learned this lesson permanently. Today, the People's Bank of China holds over $3 trillion in foreign exchange reserves, the largest in the world, specifically to prevent any repeat of 1935's vulnerability. China's currency policy, its massive accumulation of dollars, its resistance to full capital account liberalization, all of it traces back to the trauma of watching their monetary sovereignty evaporate in 18 months. And here's the twist. American silver purchases in the 1930s were ultimately futile. Despite buying 3.2 billion ounces of silver by 1961, the U.S. never achieved monetary remonetization of silver. The policy enriched mining interests, devastated China, and accomplished nothing of lasting value for America itself. The cost? Measured in Chinese lives lost to economic collapse, political instability, and the eventual communist victory in 1949, it's incalculable. 3 things to remember from Shanghai's silver nightmare. 1. Monetary sovereignty is national security. No nation can afford to have its currency at the mercy of another country's commodity policies. 2. In global finance, domestic policies have foreign victims. The Silver Purchase Act was designed to help Nevada miners. It destroyed China's economy. Policymakers must account for international spillovers, or they'll create crises they never intended. 3. Trust in money is trust in government. When China's silver-based currency collapsed, it didn't just destroy wealth. It destroyed legitimacy. Paper money requires institutional credibility. Once lost, it takes generations to rebuild. The Shanghai Silver Crash wasn't just an economic footnote. It was a turning point that reshaped Asia, empowered communist revolution, and demonstrated that in the modern world, financial weapons don't require armies. They just require indifference to consequences half a world away. Because in the timeline of wealth, every rise comes with a hidden cost. And sometimes that cost is paid by people who never saw it coming. If you enjoyed uncovering this hidden story, make sure to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because history's next secret is already unfolding.